I acknowledge the Gadigal people of the Eora Nation on whose land we meet today. I pay my respects to their elders, past, present and future, and also to all Aboriginal and Torres Strait Islander peoples here today. So on behalf of the ENFP Strategic Alliance of HLB Man Judd and the Commonwealth Bank, we welcome you here. And it is so wonderful to have so many of you here in the room today. There's nothing like the buzz of the ENFP, being online, being in a webinar, but just to be here beside each other, enjoying a sandwich and a coffee, you just can't go past this. So I'd like to introduce the teams to you because we've actually got a couple of new ENFP community members this year, which is sensational. For those that don't know me, my name is Kim Kellaway and I'm Head of Clients and Markets at HLB Man Judd. The team from HLB today, I'd like to introduce you to Aidan Smith, who is Partner and Head of HLB Man Judd's National Not-for-Profit Group, Simon James, Partner, Assurance and Advisory, Mariana von Luken, Partner, Tax Consulting, John Raphael, Partner, Business Advisory, and Georgina Radauge, Director, Business Advisory. Representatives with Commonwealth Bank, we have Yvette Flynn, who is the Senior Relationship Manager, and Blake Sinclair, who is also an Executive Relationship Manager. And our guest speakers, they really don't need too many introductions. They are incredible. We have them every year. And again, we'd like to thank you for being part of the ENFP community and presenting to everyone today. So I'd like to I'll get just to raise your hands. We have Mel Yates, Director ACNC, Frederick Hauser, who's Director AASB Board, and Maggie Mann, Project Manager AASB. Our presenters today will cover off on regulatory changes, including DGR reforms, upcoming changes to ACNC reporting and the ACNC register, financial reports, issues from the regulator's perspective, compliance, what's the current focus, resources and tools your organisation might find useful, and a question and answer, which Aidan will facilitate at the end of the presentations. There's the team, there's the presenters. Here is the ACNC, and I'd like to welcome Mel.
Thank you, Kim. Good afternoon, everyone. Lovely to be here. I would also like to begin by extending my acknowledgement to traditional owners of the lands upon which we meet. So I'll just start off, I just want to sort of outline, I guess, the main focus from the ACNC's perspective and then start off with a little bit of context before we sort of dive in to a little bit more detail. We've got a mission of maintaining, protecting and enhancing public trust and confidence in charities. Now, that is central to our mission. It's the Commissioner has been very clear that that is her North Star. And part of our responsibility is to help charities to understand what it is that they need to comply with, what their obligations are, the things that they need to be thinking about, and developing resources and tools to support and enable that ongoing compliance with obligations. We have a broader responsibility to make sure that the charitable sector is in good health, and so we play a pivotal role in that space. And one of the very important tasks that we have, which is very dear to my heart and which is important to all of you from the NFP sector and particularly from charities, is reducing red tape and trying to streamline things to free up resources so that you're not focused on paperwork, you can actually focus on your mission and your purpose. Now, our priorities are essentially linked to all of those key focus areas. And what I'm going to focus on today is the importance of the charity register. So the charity register is one of the central pillars that we use to ensure that people can access information about registered charities in Australia. The register has key information to support understanding from the general public about the charitable sector, what charities do, who they're run by, how they're funded, how they're resourced. And so what we've seen is over the last couple of years, a very dramatic increase in the popularity register. So our searches have increased in the millions each year, and now it was 8.6 million searches. And so that's increasing. And so it's very, very fundamental that the activities that we undertake are all designed to make sure that the information on the charity register about charitable entities can be relied upon, that it's accurate, that it's correct, that it's up to date, and supports that trust and confidence in the charitable sector. And it becomes a circular, self-fulfilling, I guess, in a way. Now, I do want to start just with a couple of comments on the environment, because the environment does have a big impact, and the context that we operate within, to how we can support and enable trust and confidence in charities. Now, the cost of living that we're currently experiencing, charities and not-for-profits are not immune to this. Costs are going up. People may be unable to donate or support as much, support organisations through donations, through other forms of support. There may be more demand, and we have seen that. A lot of charitable organisations are experiencing an increase in the number of beneficiaries that are looking for support. So all of these are challenges that charities have to deal with and have to manage in the current context and moving forward. Sustainability. We've seen some regulatory changes which are playing through at the moment. So I'll touch on those, noting that a lot of the changes that I'll touch on, they're actually being implemented by the Australian Taxation Office. So they're relevant to what we're going to talk about, but they're not things that I can comment on in detail because I'm not from the tax office, I'm from the ACNC. Some other things that are very, very central to the current environment are cybersecurity. So we're all aware of some of those horrendous stories and situations that have unfolded where information has been stolen, hacking has taken place, there's been data breaches, it may be mistakes, it may be intentional. So charities, again, need to be thinking about the risks that are associated with cybersecurity and making sure that their information about beneficiaries, about their volunteers, about staff members is safe. And so that's a focus of ours at the moment. And I just thought it's relevant just to touch on the Edelman Trust Barometer. So that's an annual online survey, a global survey, and that is run each year, which includes Australia. Some of the findings from that are quite interesting. Some of the findings show that businesses are the most trusted organisations. People are concerned about cybersecurity and information wars that are playing out across the globe. Science is also being viewed as being politicised. So there's some interesting things across the charitable space and across the environment that charities operate within. So I just think it's important just to consider those things and how they may impact trust in and opportunities to help that trust and confidence in charities. A little bit about the size of the sector. So the reporting that we collect each year, we undertake a lot of analysis of that reporting, and we put out an annual charities report. And last year in 2023, the total size in terms of total revenue of Australian charities, noting that there's around charities in Australia, all of which have to be not-for-profit entities, but further to those 60,000 charities, there are potentially hundreds of thousands of not-for-profit, which are registered charities. So it's important to appreciate that nuance and that distinction, and I'm only talking about registered charities. government fund a lot of the resources that go into the charitable sector. So the report found that government funded around $97 billion of that total 190 billion. Donations and bequests, about 13 billion. So significant amounts of money. And if we look at the population of, in that 60,000 figure, there are a lot of micro organisations around the kitchen table, around someone's dining table, type of organisations that are in by volunteers. And we know about half of charities are run by volunteers, right up to those very sophisticated, major economically sized organisations like universities, for example, that are earning billions of dollars themselves in one consolidated group entity. Charities are very good at earning their own revenue. So around $59 billion we found was generated through the provision of goods and services users are paying for or subsidising in some form to support the operations of Australian charities. So what are we doing in terms of ensuring the integrity of the register? So we do this in many ways. That we do this is we do specific reviews of some charitable organisations which have deductible recipient status. So that is that they're a charity and the ATO has provided them with the ability to raise funds through donations to be able to give out tax deductible receipts. So that's a very advantageous incentive to help donations. And there's a lot of talk at the moment playing out with the Productivity Commission, who are currently doing an inquiry into philanthropy. So the current government want to double philanthropy in the next sort of short to medium term. So they have tasked the Productivity Commission with looking at that. And the Productivity Commission have put out their draft report. Their final report is due out a little bit later this year. So we're likely to see some changes in this space. Our role in this space is to make sure that those organisations who are DGR entities are in fact eligible charities. So what we found, the ACNC was created before that time, the tax office were the custodian of the register of charities in Australia. And what we found is that there are a lot of organisations that applied to become a charity and were given DGR status, but through decisions that are taken, through a bit of mission drift, they move off into a different direction. And suddenly the organisation is not doing what they were set up and approved to be doing. So our focus here is on making sure that organisations that do have deductible gift recipient status are in fact eligible charities and they are pursuing their charitable purposes in line with what they should be focusing on. We do a bit of work looking at the financial reports and the financial reporting in the annual information statement of charities. So we look at a small sample of those each year and do a bit of a deep dive analysis to look at things that we might be identifying as issues, trends, things that we might need to focus on to improve the resourcing or the education or the tools that people need who are entrusted with governing charities so that they understand what the obligations are. So there's a multitude of reasons that we do those. We've also been funded by government to do some compliance reviews. So this sort of commenced, I think it was about 3 years ago now. We were tasked with looking at the activities of charities to make sure that we were being proactive, being on the front foot. So before problems take hold, do some analysis of some organisations and understand what some of the problems might be that charities need to address. Reporting is mandatory each year through the annual information statement. And so what we do is we have a program of work that removes organisations, registered charities, that haven't reported for 2 periods. So we figure that that is a governance failure, that is a concern. Trust and confidence can only be maintained when there is information about charities available on the register. And so if a charity can't provide that reporting and is not meeting those obligations, then that is the, I guess, the point at which we as the regulator say, enough's enough, you will now lose your entitlement to charity status. And so we have a process where we can support those organisations. If they correct their governance, bring their reporting up to date, they can come back onto the charity register. Now, I will touch on some DGR reforms. So these are relatively new. From the 1st of January this year, there was a change to the registers. So there were 4 registers that used to be managed by other government organisations. So we had the Register of Cultural Organisations, a Register of Environmental Organisations, we had a Register of Harm Prevention Charities and Overseas Aid Gift Deductibility Organisations. They have all been centralised, so the ATO are now responsible for assessing DGR eligibility for those 4 registers. Another government change was that most DGR entities, and that there are exceptions, one of those exceptions are organisations which are government organisations and they can't be charities. Otherwise, most, not all, but most charities that have DGR status should now be registered as a charity. So I should say most DGR organisations should be now registered as a charity. And as part of the reviews that we do in that space, we have an obligation to check 2% of organisations on our register that have DGR status to make sure that that eligibility is maintained. Now, when we actually look at those organisations and do those checks, what we're finding is a very, very small number of organisations have moved away. They've drifted and they're not necessarily conducting the purposes that the organisation was set up to push and undertake. And so we find that a very small number, around 1%, end up losing a subtype that they have been registered with. We find that nearly a half, 43%, very, very rough terms, they maintain their full entitlement. There's no issue. We work with a large number of organisations to fix some of the governance issues that we identify. And so again, they maintain their entitlement to be a registered charity and maintain their status as a DGR entity. But what we do is we do work very closely with organisations when we have to. A lot of this work we do without the organisations even knowing. So we use publicly available information from the organisations, information that we have and we collect, websites, other public sources. And so what we're able to do is a large number of these reviews, the charity doesn't even know that they're being looked at. And then after the fact, we move on to the next one. Where we identify an issue, we will reach out to the organisation and work with the organisation to try to resolve the issues that we've identified. So we did about 480 of those reviews last year. And the things that we're looking for, there's certain risk factors. It might be that the governing document is not complete. The organisation might not have a publicly available governing document. The number of responsible people, that is those who are responsible for the organisation's governance, there might be insufficient numbers on the register, which indicates to us that there is something amiss. The organisation hasn't fully updated us with those who are making the decisions on behalf of the charity. So they're examples of the types of risks that we look for. On these slides, which will be circulated post today, there's a range of resources and there's some links that have been included. Please avail yourself of those resources. So one of the things that we have developed is a self-assessment tool to help organisations to work through some of the things that are important that the organisation can identify. Yeah, we need to work on this, we need to improve this. And it's a good tool to work through to make sure that the minimum standards and the minimum expectations are being met. Now, some reporting changes. So not new now, but in 2022, we did have a change to the size thresholds for registered charities. So the 3 different tiers have remained. Charities can either be small, medium, or large. What happened, there was an indexation of the reporting thresholds. So small entities can now earn revenue each year of up to $500,000. Once an organisation hits that $500,000 mark, it is deemed to be a medium-sized charity and it must prepare financial statements. Those financial statements must, as a minimum, be reviewed. And then large organisations are those with annual revenue of $3 million or more. Again, financial statements are mandatory, but an audit is required. Now, there are some instances where some organisations will choose to have an audit when they don't need to under our reporting framework for a range of reasons. The board might be comfortable getting an audit. There might be a requirement under the charity's governing document, whole raft of things. Some state and territory factors come into play here as well. For example, fundraising. So some state and territory regulators do have some specific requirements around fundraising reporting. So it can be a bit nuanced in that space. But some of the recent information that we've started collecting from 2022 includes key management personnel. So remuneration of key management personnel. That's been quite a big change for the charitable sector. It only affects large sized charities, $3 million or more, and we're collecting that in the annual information statement. Separate to what we collect in the annual information statement, charities may be required to report this information in their financial statements, depending on the type of financial statements that are being prepared. The biggest thing that has happened recently is from 2023 in the annual information statement, reporting of related party transactions. Now, this has been a significant change for many charitable organisations, needing to understand what this means, needing to make sure that there are systems, processes and controls in place to identify these transactions, collect information about them, and then report on them. So we've developed a suite of resources and we've really focused on pushing this message with the charitable sector. So again, I would encourage you, if you're not sure whether your organisation is where it needs to be in terms of reporting related party transactions, to please use the resources that we have available on our website to help increase the, I guess, sophistication and the awareness within your organisations to make sure that you're meeting those requirements. So this is just a sample of the question from the annual information statement, again, for large charities only, but we specifically ask large charities if they have key management personnel. We want to know the number because there is an exception where a charity only has one key management personnel. They don't need to report that for privacy reasons. So that's why we're asking about that. And then in aggregate, the total amount that's been paid to key management personnel is collected as well. Related party transactions. So this is for all sized organisations with the exception of basic religious charities. So depending on the size of the charity, different questions will be asked in the annual information statement, collecting information about related party transactions. So it's streamlined for small charities. and we collect a little bit more information for those organisations that are medium and large in size. And again, this is the question for, that's an example of medium and large. And basically what we're collecting is categories. So asking charities to indicate whether they have different types of related party transactions. There's also a provision there to include additional information. And what we're trying to encourage charities to do is that if they have a financial report, because they're a medium and large sized charity, is rather than copying and pasting the same information, it might be better to include a page reference to the financial statements, the notes that might include relevant disclosures about related party transactions. So trying to streamline that process. Again, we have developed and we worked very closely with charities to ensure that we covered off the key things that charities need to know in terms of collecting and reporting this information. So please have a look at that web link there. And if you do have any feedback about the guidance, more than happy to receive that and appreciate that, in fact. So red tape reduction. Now, this is, as I said, a very, very important element of what we do at the ACNC. We do now have the outcome whereby all organisations across Australia that are incorporated associations can access a streamlined reporting arrangement through the ACNC. So that is a benefit. It saves the organisation lodgement fees. Many states and territories charge a lodgement fee, and it saves the need to report that more than once. So that is a good thing. We are still making sure that we are doing what we can to remove other elements of red tape reduction for charitable organisations. The key here to take advantage of these streamlined reporting arrangements is to make sure that your charity is providing the information that we need to give back to the state and territory regulator. For example, the incorporated association number or fundraising number, and making sure that your charity answers the questions which we include in the annual information statement that the regulator wants to know, so that we can pass that back to them so they don't have to come and ask that from you separately. Now, I just thought I'd touch on some of the common issues we see in financial reports. We do see a lot of charities mistakenly report the type of financial statement that they have prepared and they are providing to the ACNC. We also see some incorrect financial information included in the annual information statement. That might be by way of transposition error, for example. So we do check the accuracy of the reporting, because ultimately if someone looks at the charity register and the information they're looking at is incorrect, that erodes trust and confidence in the charity register. And so that is diluting the maintenance that we're trying to keep in terms of trust and confidence of the charity sector. We have found that there has been a sustained lack of disclosure or insufficient information about accounting policies, about accounting judgments. So if you're making assumptions, if you're making decisions about how something is going to be reported, include that information in the notes so that users of the financial statements can have that information to help them understand the types of policies that the charity has, the types of assumptions and calculations that have affected the figures that are being reported in the financial reporting. Now, some of the things that we do in order to support charities, first and foremost, we develop a lot of web guidance, content. We have webinars, podcasts, we have videos, we have all sorts of different formats of information to try to help those in the charity sector understand what it is that they need to do. We also have a lot of pages of information. We have fact sheets, topic guides, and we also have a monthly newsletter that I would encourage you to subscribe to if you don't receive that. The thing that I like about it, and I'm spruiking it because I'm from the ACNC, but I actually like to read it each month because the Commissioner will touch on a particular topic, and it's just good to refresh our memories of the things that we need to be thinking about. And in that publication, we'll also include anything that's changing, any new resources we might have, anything that might be relevant for charities to be thinking about. So I highly recommend that. It's not a long read, and I've got the instructions for how to subscribe to that very shortly. We do have an advice line. So where a charity is in dire need to speak to someone, we are a small government organisation, so we don't have a large number of people that we can resource to this service, but it's a very important service, and that is available if someone does need some assistance and they need to speak to one of our customer service staff. We do send lots of communications to the charity address for service, reminding the charity about obligations which might be upcoming, which might have been forgotten about, which might have been overlooked. So very similar to, I guess, not paying the utility bill. You get a reminder, and then that wording and the look and feel of that communication changes if the due date for reporting has passed. One of the very important things that charities need to be aware of is that if they identify a reason, an impediment that is going to stop them from reporting by the due date, it's really critical to contact us early. Let us know what the issue is. Let us know why it's an issue, and we can work with you to try and resolve that and give you an adjusted or a deferred due date. We do have a policy on our website which outlines the process. We've tried to streamline that as much as possible, but it's really important that we don't get contacted after the due date requesting an extension, because chances are that extension won't be forthcoming. It's really important that charities are on the front foot and are aware of when their annual information statement is due and are trying to do whatever they can to meet those timeframes. I've already talked about those new pieces of information which are available on the register. What we're finding is, certainly with the introduction of key management personnel remuneration reporting and related party transactions, certainly the media, for example, have been very interested in this information, wanting to learn more about what's going on with charitable organisations. So it's a good thing that there is disclosure, but it also can result in, I guess, some fueling of interest and pushing certain agendas in the media. So there's a balancing act there, but I think overall it is a good thing to have that information out in the public domain. The compliance reviews that I talked about that we were specifically funded for, one of the things we've focused on is founders syndrome. So that is where an organisation still has a lot of influence from the founder of an organisation. So when a charity begins, that emotion and that passion is so important to get the cause up and running. But what we find is that over time, if the organisation doesn't adapt and get the skills and the support on its board that it needs in that evolving life cycle of a charity, and the founder still has a lot of control and a lot of influence, what we find is that's not necessarily a good thing. And we find that that results in some significant concerns and often governance failings. So that's been a big focus of ours. Sustainability, we have looked at that before. We have also looked at organisations which are operating overseas, particularly with vulnerable beneficiaries. So we did do a bit of work looking at orphanages who are operating overseas and making sure that they have adequate controls and safeguards in place, and they're meeting the external conduct standards which many of you would be familiar with, which require protection of assets, reporting, making sure that you've got processes and controls and systems in place, working with any partners you might be working with, making sure that you're vetting and have, an adequate safety net in place for any people that you might be engaging with outside of Australia. We've also found that there are risks associated with organisations that have large boards. So we've found that not having enough board members, but having too many can also be problematic. So they're just some of the things we've looked at. And we also did look at organisations which received a large amount of incoming donations. You might recall back in 2019, 2020, when we had those horrendous fires, there were some organisations that have benefited from very significant amounts of money coming into the organisation in a very quick amount of time. So we wanted to make sure that people weren't exposed and that the public had faith in those donations, that they would be used well and put to good use. And so what we found is we went and did some work with some of the largest beneficiaries of those donations. And we were very pleasantly surprised that those organisations had really good, sophisticated ways of managing those funds. Unfortunately, though, what we found is that the public expectation is that the money will be spent now. The money needs to be spent now. Why hasn't all of this money been spent? The reality is that after disasters of the magnitude that we saw, and we see it with floods and things of that nature, the infrastructure and the need to rebuild is there for years. It's not an immediate solution. There are short-term immediate things that need to be done, but there is a pipeline of time and the needs change over that time frame. So it's important to try to help people to understand that it's not just the here and now. It's thinking about in 1 year, in 2 years, in 5 years, in 10 years, when the community is rebuilding and they need to think about what it is that they need to support that community. Now, disseminating information. So I've really talked about some of the things that we have available in our website. We do update our guidance and we try to put out the findings from things like our compliance activities, from our DGR reviews, from our analysis of financial reporting. So all of this information is available on our website, and we try to push that periodically to help people to understand, again, what it is that they need to do. We do have some targeted communications, which we focus on particular cohorts of charities within the sector. As you all know, the sector is very diverse. It is not a one-size-fits-all sector. And so we need to work harder with some parts of the sector and certain organisations compared to others. The charitable purpose, again, this is a really important way to stay up to date with what is happening in the charity space. I have touched on webinars and podcasts. So we've got we had a webinar about related party transactions, which was really, really popular. And some of the podcasts we do, we've had some really good feedback about how valuable some of that information is. So again, if it's something that you can do when you're driving, when you've got some time, that might be something that is worthwhile looking at. We've also started publishing some registration decisions, and that is they're de-identified decisions. So this is a change that is relatively new. We started this late last year. What we found is because we make an assessment of eligibility for an organisation to become a registered charity, people want to understand some of those novel or potentially complex things. Why did that organisation get onto the register, but there's another organisation that's similar, but they don't seem to be eligible? So it creates questions. So what we're trying to do here is fill that void with reasoning, with de-identified decisions as to why something might not be eligible, why something might be eligible, to help educate the sector about some of the considerations which are important to us, which are obviously important to organisations that want to be a charity, and what they need to be thinking about. And I've also talked about the Charities Report, which is our publication each year, and I'll touch on some of the data that's available in our Data Explorer. All of the information which we collect from charities each year in the annual information statement, we make available because it's important that people are able to understand the sector as a whole. It's important that policymakers have visibility of the scale of the sector and the types of things that the sector undertake across our community. So we try and make as much data available as we possibly can. And this is used by researchers, by policymakers, by people in the sector who are just interested in understanding what my state, what my territory, what our part of the sector looks like in terms of scale and size. So you can slice and dice a lot of this information to suit your particular needs and your particular interests. And that is available free of charge. And there's also data sets available on data.gov.au, which is the Australian government data repository. So there's a lot of information about registered charities, each iteration of annual reporting, as well as a range of some other data sets as well. Some of the recent things we've done, and I apologise, that's very bad placement of that little link. Apologies for that. Some of the things we've recently done is we did launch a couple of years ago an e-learning suite, a bit of a foundational suite of, what would you call them? Resources that board members who are becoming board members for the first time, what they really need to know, the foundational fundamentals that they need to have covered for them to be effective as a charity board member. We're going to be changing that information, and we're going to be changing that, using a lot of that content to think about how we can condense it down into shorter sort of modules, if you like, and repurpose that, thinking about the changes that we're seeing in terms of learning and the takeoff in micro-credentials and people wanting shorter, sharper sources of information that they can digest and complete. So that's what we're embarking on at the moment. Last year was a very busy year with our Commissioner interpretation statements. We released revised versions of some of those, and there's still a few more in the pipeline, which will be coming out in due course. We really invested in getting our guidance right for the annual information statement last year with the introduction of related party transaction reporting, because that really is a massive change for large parts of the sector. I've already touched on the de-identified registration decisions, and again, cybersecurity. Next month, we will be embarking on a campaign in conjunction with the Australian Signals Directorate, specifically to help charities to understand some of the things they need to be thinking about and some resources that they can use in order to build up that capability and make sure that they are protecting information that they have for beneficiaries, for employees, for volunteers, so that the organisation is not at risk of being taken advantage of and exploited by many characters which like to do that. Now, the year ahead. So we still have a bill before Parliament, and that's in relation to secrecy reforms. So there's been a lot of discussion and debate about the fact that we can't comment on investigations that we undertake. We can't disclose information about many of the regulatory activities that we do. And that's to protect the organisations that we are working with or we are taking action against. What the government is proposing is that there will be a slight softening of this posture. So that means that we may, in certain circumstances, be able to make disclosures about some of the activities that we're undertaking. So that is still, I won't preempt what's going to happen there. It's still before Parliament. So we'll let our masters debate and work out where they sit big things that is happening at the moment, and this is especially for not-for-profit organisations. There is a raft of measures which are being implemented by the ATO, the tax office, and that is in relation to organisations which self-assess their income tax exemption. So there's going to be big changes there with the introduction of annual reporting to the tax office. There will be a push for some of those organisations who perhaps should not have that entitlement. There may be a push for some of those organisations to become a registered charity, because the government is introducing this reform to increase the scrutiny on the not-for-profit sector, to make sure that only those organisations which are truly entitled to have that self-assessed income tax exemption to maintain it going forward. So there's been a bit of talk about that at the moment. I've touched on the Productivity Commission inquiry. That is due in May of this year. There was a little bit of contentious material in the draft report, some very strong views for and against some of the recommendations. So we'll see where that falls, and that could produce changes to the regulatory environment that will be relevant at a future update. The Department of Social Services have set up, and this is off a request by government, an expert reference group to try and improve the not-for-profit sector, particularly the capability of the not-for-profit sector. So we might see some announcements and some changes in that space. We are an ally to this, so we're very invested in making sure that whatever is recommended or developed out of this expert reference group is appropriate, fit for purpose, and helps charities. And one of the big things that we'll be doing this year is we will be introducing a new registration application form. So to become a registered charity, you have to provide quite a lot of information and quite a lot of documentation to satisfy us that you do meet the eligibility criteria to be a charity. We are launching that probably around mid-year, and we've invested a lot of resources in making that a pretty schmick product, which will hopefully collect all of the information that we need and stop some of the back and forth which occurs at the moment, where we have to go back to organisations and clarify things, get additional information before we can make that assessment of charity status. One of the other things we're doing as well is we're exploring how we can implement multi-factor authentication. So many of you would be familiar with this, either at your workplaces or with banking, online banking and the like. You've got to get a text message sent to your phone or an email sent with a PIN to make sure that it's you that's accessing the information that needs to be securely maintained. So we're looking at how we can do that, which will be a very big change to the way we use the charity portal. And finishing off, this is just our socials, and the second last slide, or the second last box there, if you want to subscribe to the charitable purpose, that is how you do that. Just our website /subscribe is the way that can be done. Thank you very much. I will hand over to Maggie.
All right, that's going to be hard to follow up. He's always an amazing presenter. He's also my ex-boss, so. So I'd like to thank HLB Manager and also Commonwealth Bank for inviting us to talk about some of the key projects that we have at the moment, our double ASB work program that will be or may be relevant to not-for-profit entities. So I do have to say our usual disclaimer. This presentation provides personal views of the presenter and does not necessarily represent the views of the AASB or other AASB staff. Its contents are for general information only and do not constitute advice. The AASB expressly disclaims all liabilities for any loss or damages arising from reliance upon any information in this presentation. So I'm sure you will have lots of questions for us, and we do have a Q&A session, but as much as you do have questions for us, we actually do also have questions for you. So there will be some questions on some of the slides relating to some of the projects. So this is the agenda we have for you today. I will be covering off on the not-for-profit financial reporting framework project. It's actually my baby, so I've been working on it for quite some time now. And then Frederick, or I call him Freddie, he's going to take you through the remainder of the session. So he's covering off on an update on the not-for-profit post-implementation reviews, service performance reporting. There's also some forthcoming international accounting standards that may be relevant to not-for-profit entities, and also at a very high level, covering off on the climate-related financial disclosure project. So we'll start off with the not-for-profit financial reporting framework project, which has been on our work program for some time. And I'm sure a few of you or many of you will already heard about it or participated, where HLB Manjad invited our lovely Carmen Ridley last year to run through some of the key proposals in the discussion paper. But in terms of the objective of this project is to develop simplified financial reporting requirements to meet the needs of users of small and not-private sector entities. We issued it about 2022, and we had a 6-month consultation period, which closed on 31st of March last year. In the discussion paper were the board's preliminary reviews of some of the accounting topics that we would include in a future Tier 3 standard, which were simplified recognition and measurement requirements compared to the existing Tier 1 and Tier 2 requirements that we have in the current Australian accounting standards. And at the same time, the board was also consulting on the removal of the ability for certain not-for-profit entities to prepare special purpose financial statements if they were required to prepare financial statements in accordance with Australian accounting standards. Link on the public with all the publications that we issued, including the discussion paper. We also had a snapshot document, which is a very high-level overview webcast. So for anyone that is interested in what those proposals were, now those proposals may have changed. The board's reconsider a few of them since, but if anyone's interested, the link will take you to those documents. Right. Now, we did receive an overwhelming number of responses. So again, from an organization's perspective, I think it's one of the highest number of responses we had to of the project, although our sustainability team may think otherwise because they're still doing their consultation at the moment, so it's not competition. But anyways, so thank you each and every one of you who really participated and provided feedback, whether or not it's via a survey or you attended one of our outreach sessions or even provided a comment letter. So I really thank you for attending or providing us feedback, because with the feedback, it's been really helpful for the board to consider how best to proceed with the project. So we received, the board received an overwhelming support to proceed with the project in developing an exposure draft of a T3 accounting standard with simplified accounting requirements for certain not-for-profit private sector entities. And the board also approved at the same time a separate exposure draft to remove the ability for certain not-for-profit private sector entities, not just not-for-profit private, but not-for-profit public and private sector entities to prepare special purpose financial statements. We decided that the drafting of the Tier 3 requirements will be based on the international financial reporting standards developed for smaller and medium enterprise accounting requirements as a starting point, but also considering other international frameworks or pronouncements, such as the international non-profit guidance that's been developed by the IFRNPO, the International Financial Reporting for Organizations. And also we are considering as well the Tier 3 standard that they have in New Zealand, which is quite a simple standard for small and not-for-profit entities to follow. So we are considering other aspects in terms of our drafting. Now, since the comment period's closed, the board has been deliberating on a number of the accounting matters based on the feedback. So if you are interested in following the project, we do have we do publish all the decisions that have been made by the board and a project summary, which you can access via the link. So we do update that regularly every time we have a board discussion and that the board has made a decision on this project. Now, this looks like a very busy slide, so I'll just keep really wanted to go for a very high level. So on the first column are the list of topics where we received overwhelming feedback, which supported the proposals in the discussion paper. So the board was happy for staff to proceed with drafting the T3 requirements based on those proposals in the discussion paper. So for example, with fair value measurement, the feedback was that keep the definition the same as what we have in the requirements in AASB 13, but make it simpler with simpler language and more tailored to not-for-profit entities. Another topic that stakeholders really supported was the income model that we developed for the T3 standard. So just through at a very high level is to allow an entity to defer income where there's a common understanding in an entity and the resource supported by evidence either in writing or in another form on how those resources will be used in a way. Now, the middle column and the third column are where we receive feedback from stakeholders where they may not agree with the proposals in the DP or at least some aspect the reporting requirements that was the preliminary requirements that we developed in the discussion paper. Now, the column, we have actually since deliberated most of those topics to date, except for the last two where we will be discussing primary financial statements and the initial measurement of assets acquired at significantly less than fair value at our March board. And then in our, so I do want to mention that, which I'll talk about some of those topics in the next two slides, that the board has made different decisions based on the feedback that's what was initially proposed. So we do take feedback on board when we do develop the requirements. So and finally, in the last column, and it's a very short list, which is very good, with remaining topics is yet to be considered by the board, which we will be taking for further consideration, hopefully in June. So based on that, we are on track, delivering or at least expecting to issue an exposure draft, things like that. Expecting to issue an exposure draft in the second half of this. So there another round of consultation so that when everyone get to see what those the requirements are to actually come back to us and let us know whether it's going to work or not. So in these next two slides, I do want to mention some of the decisions that the board has made that was different to what was initially in the discussion paper. So for example, the hierarchy approach, which is developed where if a transaction or if guidance isn't provided within the accounting standards, this hierarchy approach is supposed to guide an entity to determine what they need to do to account for that transaction, for example. So in the discussion paper, the board decided that entities should refer to the T2 requirements because there's already guidance there in the existing Australian accounting standards, and they thought it would be just easier for them to refer to those T2 requirements. However, based on the feedback that we got, we decided to refer entities, allow entities to develop its own accounting based on the T3 requirements as an analogy to actually account for that transaction in the spirit of keeping the T3 standard as standalones as possible. So we didn't want to, direct entities to always go to T2 because we are trying to develop a standalone standard so they can just refer to the single standard in one place to treat a transactional event. But entities can still refer to the T2 requirements if they want to. Now, consolidation, in the discussion paper, the board decided to allow an accounting policy choice for a parent entity to prepare separate financial statements with disclosures of its significant relationships as an alternative to requiring consolidation. So that's actually an accounting policy choice rather than forcing everyone to consolidate. Now, based on feedback, we definitely we had overwhelming support that we should keep the accounting policy choice. So that's definitely kept in terms of in the T3 requirements. But the board actually discussed further what we meant by significant relationships and what those disclosures are. So I won't go into more detail there, but at the moment, we might change the significant relationships to notional relationships, but we might think of other alternative terms as well at our March board meeting. So it might now maybe refer to important relationships, but I guess just watch this space because they might be subject to further changes, but definitely the accounting policy choice will remain. And again, investment in associates and joint ventures. Initially, the board decided to set requirements based on what the type of particular entity it is. After hearing feedback, the board decided that restricting a measurement basis might than the existing T2 requirements. So the board decided to actually allow an accounting policy choice for an entity to decide whether or not they want to measure it at cost or fair value or apply the equity method. Now, related party disclosures, Mel's touched on that. It is an ACNC requirement. So initially, the board decided to keep with consistency with the T2 requirements because related party disclosures, as Mel's mentioned, it does get a lot of media attention. It's quite, it does provide information to users. So, but the board was also conscious to actually provide some, relief for T3 entities. So whilst we do propose to remain consistent with the T2 requirement, decided that donations from a related party would not be required to be disclosed unless there's evidence that those donations could influence the activities of the entity or change the or like the governance or things like that. So we do with the ACNC guidance quite heavily when we were developing the requirements for the T3 stuff. So it should be consistent with the ACNC requirements. Now for financial instruments, again, I know it's such a great topic to discuss, but so financial instruments, it was there were bits and pieces that we kept where some things changed. So measurement of financial assets, health capital, return and income will be subsequently measured through fair value through P&L. But the board decided to provide an irrevocable to measure those fair value changes through other comprehensive income if they want to. And with primary financial statements, this is actually, as I mentioned, it is actually going to be discussed at the March board meeting, but actually recommending the board is that the primary financial statements should be consistent with what we have in the T2 requirements, SB 1060. So allowing an entity to prepare unless there's certain conditions that requires them to prepare a statement of change. So before I hand over, it's going to steal the thunder now, but as I mentioned, we are going to be discussing our March board meeting, but we are also going to be bringing for the first time to the board for a working draft of an exposure draft of the T3 standards, at least some of the sections of it being drafted. So for anyone that's interested in this future T3 standard look like, please have a look at our public staff paper, which contains our working draft. So hand over to Freddie. Take you through the session. Thank you.
Thank you very much, Maggie, and good everyone. And you can call me Freddie. It's easier than Friedrich for English-speaking people. All right. So the rest of our work program, obviously, this is not all of it. Unfortunately, I should say this much, but we try to pick a few of those that might be close to your heart and important to you as a not-for-profit representatives, and at a higher level. Recognizing that it's not all accountants that are in the room, but feel free to pass a message to your CFOs and financial managers, etc. So the first one I'm going to touch on are the post-implementation reviews, which I will move with slides here. We are doing regular in line with our policies, including the one that is the evidence-based approach. And so essentially the aim of post-implementation reviews is to see whether the standard that has been issued, say, for 2 years, which is usually where we do those peer reviews, is working as intended and whether costs and benefits are as expected. So thank you for those that we have done last year, which is the of income recognition, which is a topic that is quite topical within the not-for-profit sector since I started with WSB. At least, and also the ITC 51, which was the PIR of control consolidation related parties, and some disclosures that apply to the special purpose financial statements. There's a few slides on the ITC 50 and the feedback, so I will not go in a detail there. What we are expecting there, that the board will finalize considering the feedback, well, actually at the March meeting, and then we'll make a decision whether to take any steps arising from that post-implementation review at its meeting, I think in June this year. And then the board will consider the feedback on ITC 51, which I think control was close to the heart, those that responded to that post-implementation review in not-for-profit space, as expected. One post-implementation review on our horizon that we are kicking off right now with some kind of planning and scoping is the post-implementation review of WSB 1060, which is those simplified disclosures that we released years ago. I'm not sure how many not-for-profit entities represented in this room adopted that standard, but if you were on disclosure regime previously, then you were probably disclosures. That standard will also become probably even more important once we will remove the special purpose financial statements, and those entities that will be not eligible, subject to decisions of the applicable regulator to apply tier 3, they are likely to tier 2 unless the regulator require them to apply tier 1. So please keep an eye on this post-implementation review. We are planning to issue invitation to comment this calendar year, and keen to hear your opinions with that one way or another. Now, happy to take feedback now, or you can see the questions over there, and please, we will see our contact details at the end of the presentation. If you'd like to actively participate in this one meeting or conversations, please get in touch, and we are keen to talk. I'm mentioning that we will consider this post-implementation review of 1060, the simplified disclosures, together with a forthcoming standard from International Accounting Standards Board on something what they call subsidiaries without public accountability disclosure. Why we are considering these two together is because this one, with 1060, we jump ahead of the pack, and now International Standards Accounting Board is doing something what we have done already here 2 years ago. And that actually puts the board and us as a staff in front of quite interesting discussion what to do with two similar standards, making sure that you guys don't have too much work unnecessarily with any added complexity of the financial reporting. I'll go chat on that later. Moving on to more details in terms of what we heard from post-implementation review on income recognition. As I mentioned, that was a topic I joined WSB in 2019, and first 2 years there was not a day without not-for-profit space across not-for-profit, private, and public sector. I'm not going into detail, but clearly the sufficiently specific. So how contract or grant agreement is specific to in defining the performance obligation, that was definitely something that creates judgmental issue and a bit of work in not-for-profit space, probably because those grant agreements are not necessarily worded in similar way as are contracts in for-profit space. So we are hearing loudly and clearly that. Also, that in conjunction with other income recognition criteria in WSB 1058, we are hearing are not necessarily working as maybe originally intended, and many entities preparing something what I would call management accounts on top of their statutory, explain to their stakeholders and board the outcomes. So again, we are hearing clearly that something that is potentially to be done. Now, I cannot make decisions on behalf of the board, so it's really board receiving that feedback and this probably in June whether they will do anything with it. And positive commercial reviews are not setting projects. So if there is an action arising, it will be a project. So don't worry about a new standard anytime too soon. Principal versus agent, topic that has been probably high on the list from not-for-profit stakeholders. On that one, ISB, the International Accounting Standards Board, is doing their own positive review of 15, IFRS 15, and that topic is the one that received significant or the most feedback from globally from for-profit stakeholders. So we'll be also closely monitoring international board decides to do with that, and then probably considering how we should react here locally on that one. Capital grants, for convenience clauses are one of those topics that we have received few queries, probably as a part of the implementation efforts, but they don't necessarily seem to attract as much attention to the topics I mentioned these days. And accounting for research grants, very particular topic for universities, and still a fair bit of discussion going on, but didn't necessarily transpire through the feedback we received as a part of the post-implementation review. So also, when we are considering what to do next on these reviews, and is also to ensure that we are using public money and funds, being staff time and salaries and board salaries in most effective way. So sometimes we have to choose our battles. Well, not sometimes, always. Moving on, also in the interest of time, service performance reporting. That's something that has been looked at by WSB in 2016, when some of you maybe in the room remember exposure draft 270. That exposure draft received significant feedback at the time, and since then board was performing a couple of research projects and looking globally and locally on the developments, what to do with that. Most recently, after our edition for years 2022-2026, I think 2 years ago or so, board decided to activate that project, and since then was discussing with the staff again global and local developments in this space. The aim of the project is to enable not-for-profit entities sector to be able to tell how they are going about to achieve their objective in cost-effective way that is useful for the users of general purpose financial reports. We are not going 100 miles an hour on that one due to the resourcing, but also because of the kind of significance of the topics and recognizing a significant diversity of the sector. And for some entities, it's relatively easy to measure their impact and report on their service delivery. For some entities, it's not as easy. So we'll be engaging with the sector and doing further research, and and internet and experience out of New Zealand with the standard they have as a result of the joint project, which resulted here in the exposure draft to 70 that I mentioned before. But also globally, I'm a member of a technical advisory group for that is developing a first international guidance in terms of financial reporting, and they do. The exposure drafts do propose to have a narrative reporting, including service performance reporting for those not-for-profit entities acting globally. So that's another source. At New Zealand, and even possibly using the standards as a primary reference. I've always admitted that I don't like to recreate the work. Well, why not to start with that? But clearly also recognizing the Australian environment compared to New Zealand. And there's a few things that board, in terms of the working assumptions, did not make a call yet. For example, whether if there is any resulting pronouncements, whether it will be mandatory or voluntary, and what would be first. So still very early days, but if you have any feedback along the way, one way or another, please pick up your phone, send me an email, find me on LinkedIn, and I'm always open to the feedback and comments one way or another. Because the earlier we hear that, the earlier we can react to that. And so I'll leave it there. And obviously, I'm just looking at the slides and I mentioned the Productivity Commission inquiry in philanthropy. So we actually did submit comment letter to that inquiry together with Barrick. Not sure if it's already on the Productivity Commission website, but it's available on our website as a public submission. I will just leave with, if you know about maybe your organization or someone else with excellent or great example of report or service performance reporting, please do let me know, and I'm keen to see those best practice examples. And if you want to share something that is not really best practice, quite on the other side of the spectrum, please share that as well and tell me why. A couple of slides now on those standards coming from the International Accounting Standards Board that may have some not-for-profit impact and considerations here in Australia. The first one is something that will become IFRS 18, approved by the International Board. And it introduces some changes into the presentation of the financial statements and in cash flow. We introduced two new subtotals, being operating profit and profit before financing and income taxes. It will require disclosure of management-defined performance measures to reconcile those to the we'll have some more principles of aggregation and aggregation, and there will be some changes to cash flows. When we'll see through the slides, you will see some slides I borrowed from ISB's presentations and declared in detail. The question really is whether it's something that board needs to think about any not-for-profit modifications or further guidance, or whether it's actually something that is not that relevant to the not-for-profit organization and therefore nothing to see here. And that's really our question here. Also recognizing the fact this is about tier one. So those not-for-profit entities that prepare tier one financial statements, I'm not sure how many. There is obviously not that many not-for-profit entities mandatorily prepare tier one. Many of them will be still preparing either those simplified disclosures, tier two, or special purpose financial statements. So all those considerations will come to play when board will decide or will be deciding whether any modifications we need to make to that standard. But if you would have it, will be you need to change something in Xero or other financial reporting systems for not much bang for the buck, please do let us know as well, because cost and benefit is definitely something that is on top of our mind as well. So we'll be performing further outreach, but again, if you have any questions or concerns arising early, please do let us know. Once the ISB will come up with a standard. We will be able to perform the comparison in detail, and then I might to share with this group to solicit some feedback. That's okay. So with that, I will skip over slides that are going into more detail, but this is just illustration of those two new subtotals. There's a bit of more information about those management defined performance measure and disclosure requirements, and those principles for regulation and disaggregation and labeling, and limited change to the cash flow. So unless someone already read IFRS 18, how it may look like in the papers from International Accounting Standards Board, and is keen to hear providing feedback, don't put all your hand up. I'll move on to the other one. That is the subsidiaries without public accountability disclosures. I already touched on that. So both IFRS 18, we're expecting, I think, in April this year, so 2024. This one with subsidiaries without public accountability, I think, if I remember correctly, it's coming in May 2024. So essentially, what we are looking at is, what do we do with our WSB 1060 simplified disclosures? Do we replace that one with a new one and possibly change the scope, or do we change WSB 1060 to make it more in line with international standards, because they are similar but not the same? And from what we are from what we see as a staff, the international standard has a little bit more disclosures in some particular areas. Also recognizing that we just implemented 1060 2 years ago, so we don't want to chop and change too often. So these are, and obviously it's not just not for profits, it's for profits, it goes across the board. So not an easy choice, and that's why we are going to take some time to ponder on that and talk to people in this room and beyond. And we are going to combine the possible review of the 1060 simplified disclosures with considerations, what to do with this international standard before, obviously, it would become applicable from 1st January 2027. So when you are talking to us, please do consider both. I have some questions that I would like to, again, exercise your minds, either now or as we are walking back to your offices, whether you love 1060 and you want to keep it and you don't care about international alignment and compliance at all, or quite on contrary, there are some, I don't know, subsidiaries or members of the global not-for-profit organizations that are going to be required to comply with these international standards, so it makes consolidation at a global level for, I don't know, Red Cross, etc., easier. So we are keen to hear that feedback as well. Any takers with any comments? Again, don't come all rushing at me. I think last but not least, definitely in terms of the other parts of our work program, and Maggie already mentioned that staff is working on the climate-related financial disclosure project outreach as we speak. So you will be aware that WSB released an exposure draft, which contains 3 draft standards here in Australia for general requirements, and those specific for related to climate-related financial disclosures. And there is ASRS 101, which is like a service standard. We are conscious of the fact that Treasury has been running their consultations, plural, on the scope and transition to those requirements. So similar to the financial reporting, WSB is not necessarily the one who dictates or regulates who is reporting. We are essentially making standards, but if entities are sent to be compliant with either Australian accounting standards or Australian sustainability standards, these are the standards. So I'm pretty sure you would have looked at Treasury consultation and the scope, and you would have determined for your entity whether it would be in scope of those proposals or not. If you have any questions, can't really speak on behalf of Treasury, but I would recommend you to get in touch with them. There's some useful sentences I saw in, I think, explanatory memorandum to those proposals, and they were talking something about entities regulated to regulate impact or lack of it in terms of those proposals. So I will leave it there. But if at the same time you have any feedback on our proposals, how to approach sustainability reporting in terms of the climate-related financial disclosures in our standards, please do let us know by 1st of March when we are when the comment period is closing. I actually think that our sustainability team is in town, if not today, then tomorrow. Actually, it's today and tomorrow. So if you want to have another SSB session, feel free to go in our website, and might be still registration open for that one. All right, or complete the survey. And I think I will pause here and I will reflect on what maybe said in terms of surveys. We are using surveys more and more, and actually probably now always, because it proved the most effective tool how to collect feedback, and I would say probably especially in a for-profit space where people are struggling with time, and so it's quite an effective tool. So please do look into that. Last but not least, this is from ASB perspective, how you can interact with us and what everything you can look at our website. I will not go through all of it. And I'm not going to compare with ACNC's website, but ours is pretty slick. We have even a YouTube channel if you want to hear to my voice and look at my face again. One thing I will point down in particular, though, is that on the left down corner, thing we put in place in beta version, I think last year, but now it's not a beta version anymore. That contains a digital version of accounting standards, but not PDFs, but the ones interactive with the links and everything. Some interactive with, I don't know, big four accounting firms or HLB resources. This is trying to compete free of charge, sorry, HLB. So have a look there because it has a useful link, and if you want to read accounting standards in new way, please go ahead. I'll also mention our newsletter, just Mel reminded me there to put there. And if our slides working, well, we'll make sure that they are working when we are sending them up. In that top left corner, if you click on that button there, sign up for our newsletter, that should actually take you to the ICO web page where you can click another button to register, or actually it will open an email with, I'm here, please add me to your distribution list. So with that and our contact details, I will just thank you for your attention and happy to take any questions now as a part of the Q&A.
Thank you. Thank you, Freddie. Thank you, Mel and Maggie as well. I'll ask you all to come up. And just for a bit of self-promotion, with the Freddie was talking there about the climate disclosures, all that's happening there, sustainability reporting. We've been working a lot on that just now to look at, it will change. It's obviously changing for the big end of town initially. That's going to filter down very quickly. And in fact, as not-for-profits, as charities, you're going to have donors, government departments going to you, well, what are you doing in the sustainability space? Because if you're not doing anything, maybe the money should go elsewhere. So we do specialise. We've been looking at all of that. Nicholas Guest here is the guy that's really the #1 go-to man. But if you've got any HLB contacts, come to us. All right, we do have some Q&A. I've got some, but I'm conscious of time. We'll go to the room. So if you do have any questions, please raise your hand, and Tanya here will bring the microphone.
So much, everyone. So, question: if we're an organisation that's 100% funded, and for sustainability and maintaining our mission, we want to grow our revenue through fee for service, what's the percentage of fee for service versus charity money that helps you maintain your DGR status? Does that make sense?
So that's a good question. My understanding, and I might get your details and actually come back to you, but my understanding is that there's not a limit per se. It's the way the money is treated and the way it's used.
So obviously for reinvestment back into vulnerable communities, so that's where that money goes to. So it's about how do we fundraise through selling some of our services to corporates, for example,
Right.
and using that revenue to put back into vulnerable communities. We looked at this a couple of years ago, and I cannot tell you how many conversations we had with ACNC, ATO. No one knew the answer.
Okay, I'll get your details if I can, and I'll use my contacts in the ATO. We'll work together. We'll make sure we answer that.
Thank you. Brilliant.
Can I just offer a comment on that? I know in New Zealand they're looking at that. It's more a character of service test. This is coming to vogue at the industry. The sector was looking at this quite closely just before COVID, and it sort of slowed down. But is the charity, is the ENFP, does it take on more the major operational activities? Are they more a character of business, or are they more a character of community service? So whilst that's a pretty vague test, I think that was what they were moving towards. And I think if you look at that as a start, you can that sort of filters through. You know, the old reasonable man, you know, the pub test type of thing. Is it a character of business? Is it a character of service? If you find, so you're doing op shops, and all of a sudden you're going from 5 op shops to exaggerate to, for the example, to say 300, and then your service, your community service, has say decreased a bit. When I think it was the ATO were looking at it, they would look at that non-paper. Well, this charity is really becoming more a character of business rather than a character of service. So there's some fuel for thought there.
Another thing to look at, you mentioned Mel earlier, with the ACNC reviews, and then the ATO sometimes get involved with the DGR to make sure that charity's still doing what its constitutional documents and where it got the DGR status says that it should be doing. It's quite easy sometimes to begin, especially in this environment where money's hard to come by, to branch into different things. You've got to be very careful. You've got that DGR status, that you're not diversing too far or from anything that could impact your status as a keeping DGR.
Thank you. Quick question for Mel. One of the compliance focus areas was governance risks associated with large boards. So my question is, what do you consider a large board?
That's a very good question. I have a feeling it was sort of in the vicinity of 12 plus. Don't quote me on that because it's not my area of specialty. I'm getting lots of questions that I can't answer today. This is good, keeps you on my toes. But a larger number, often what we find is boards that are sort of around whether it's sort of 6 to 8, 9, generally is sort of optimal. When you've got 1, 2, can be very problematic, especially with conflicts of interest and those sorts of things. But then on the other end of the scale, once you start to get to 12 or more, it can become unmanageable.
Yvette Flynn, CBA. An observation for you, Mel, when you're doing your cyber security session information awareness, something that we've come across just recently at the bank in regards to directors, where they may have been individually exposed to, say, I hate to say it, Optus, and had some of their ID compromised, and they've implemented a self-imposed credit check ban on themselves. It can then impede on that non-for-profit in terms of banking arrangements and any other financial instruments or investments that they need to do. I just think that needs to be highlighted as an awareness. So just as a very simple thing, I had a non-for-profit who wanted an FPOS terminal. So the banks do credit checks on all the directors prior to issuance of any FPOS terminal. So this was for a school a division of a school funding group, and it put endless amount of time having to track down this particular director, and then senior leaders in the organisation going, what's going on, what's going on? And then also the bank going, well, what do we do with this? How do we deal with this situation now? We haven't come across this before. So just thought I'd highlight that that's an issue if you're a non-for-profit and you're not checking on your own directors that they've put self-imposed credit check bans on themselves. It's going to restrict you from a banking and financial perspective, depending on what you're applying for. It might be worthwhile highlighting that.
Yeah, thank you. And it's horrendous when these things happen. It's horrendous, the aftermath, and it has to be considered and unpacked. So that's really good feedback. Thank you.
Now, Will Cummins, Caritas Australia. What's the reasoning behind remuneration for key personnel in charities? Just by way of interest, it might have been asked already. I was just out of the room, but is there what's the central purpose behind that?
So we had a legislation reviewed. There was a legislative review that was undertaken probably about 6 or 7 years ago now, and that was built into the Act when it was passed, that there would be an independent review. So subject matter experts led that review. One of the recommendations in that review was that large charities, I think it was all, but the government response was large. I think the review recommendation was that all charities should report remuneration of key management personnel. The government at the time, they decided to apply that to large size charities. So it came as a result of an independent expert review.
Thanks.
And maybe it's part of the broader related parties transaction. So I think that's the risk or perspective that we will be looking at.
Peter McLean from Bicycle New South Wales. Hopefully I'm not incriminating myself, but the related party transactions register, I've kind of combined just the conflicts of interest register with that together, sort of two separate things, because it makes a fair sense to me anyway. But that's all kosher.
So we've made resources available. It's very hard because I don't know the complexities and the context of your organisation to provide comment. The fact that you have registers, if they're combined, I would go out on a limb and say that you're one step ahead of some organisations that are still thinking about, well, what does this mean? What do we have to do? So what? So the fact that you've got something, I think is positive. As long as you're thinking about, in time, thinking about, well, is that still appropriate? Have circumstances changed? Do we need to make that a bit more sophisticated? Do they need to be separated? I would think that that is a good starting point, but you're the one and your board need to be comfortable with the controls that you have in place that govern your particular charity or not-for-profit organisation. Yeah.
So that's a maybe, Peter. We're going to have time has got away with us. One last question I think everyone in the room would like answered, so I will ask it. And Maggie, you've worked for you both are from Mel and Freddie. Who's the better boss?
They're equally.
Good answer. Good answer. Thank you, the three of you again. That was fantastic. We really, yes, join me in a round of applause. Appreciate the time and effort that you've made to come up here today. So thank you all very again. And now I'm going to say to Blake Sinclair from the bank, come on down.
Yeah, I just wanted to also, sorry, I should introduce myself to start. Blake Sinclair, I'm a relationship executive at Commonwealth Bank, looking after a portfolio of charity and not-for-profit customers entirely, specialising in that sector. So if over the course of any time that you ever have any bank-related questions or banking-related questions as well, always happy to talk and make different connections that we can. I'd also just like to give my vote of thanks to Mel, Maggie and Freddie as well. a couple of things that I found really interesting across the session. I think probably all of us can relate a bit to that founder syndrome. So I think that's probably interesting. That'll be very interesting to follow as well, and those different thresholds as well for where organisations fit, and also definitely following that charitable purpose newsletter and those different resources available. And yeah, we'll also be interested on the accounting standards to see what we can learn from our partners there in New Zealand as well, and how that comes across. So just wanted to lend our thanks and thank everyone as well for the important work that you do and for making the time to join us today.
So the slides and the recording will be uploaded to the ENFP community LinkedIn page. We'll also send them out on via the email for you. Now, on the tables in front of you, we're very excited because we finally got our act together very early this year, and we've now put together our entire year's program for 2024. So all the dates are in now. Please note them into your calendars. If something becomes quite topical, though, we will hold a webinar or something similar to that, so that'll sit outside the program. And then our not-for-profit leaders strategic planning survey. So as everyone knows, we run 2 major surveys a year, the not-for-profit strategic planning and the not-for-profit financial management. Thank you those that participate in the financial management, because we ended up getting over 120 management key personnel inside not-for-profit sector. So that was sensational. So here's your chance again to participate in this year's survey for strategic planning. QR codes on these gorgeous little business cards that Tanya has prepared. So if you're not the right person to participate, please take these back to the office and get management to complete them for us. We would like to, again, get over 100, key not-for-profit leaders participating. And our next ENFP briefing will be held by Carmen Ridley, and that'll be on financial reporting. It's on the 27th of March, and that will be a webinar. So I'd like to thank you all again for your time. If you have any questions regarding any of the content today, please just simply contact me and then I'll put you in touch with the partners. Thank you again.